I'm Adam Brooks, co-founder of Able Financial Group. We have a wonderful presentation for you today on Social Security strategies for your retirement. It's going to be presented by one of our certified financial planning professionals, Matt Cherry, who is our Social Security specialist here at Able Financial Group. So please feel free to ask questions. You can use the chat feature on your software here to submit questions, and we will address questions on Social Security today. This is being recorded, so for those that would like a copy afterwards, we're happy to send that to you. And if you know anybody that could benefit from this education today, just let us know. We're happy to reach out to them as well. I'm going to turn it over to Matt. Thank you for your time, and here we go.
All right. Thank you, Adam, for that warm introduction. Welcome, everyone. I recognize a lot of the names on here today. If we haven't met, I am Matt Cherry with Able Financial Group. I'm glad you're here. So today, as if you already don't know, we're diving into a topic it's often misunderstood, it's frequently debated, and sometimes even feared, Social Security. Now, I know that might not sound exciting, but I promise you, this one program can have a huge impact on your retirement income. And if you make smart decisions, you can unlock a lot more value. We'll try to keep it fun, keep it clear, and yes, there will be a few bad jokes. Fair warning. Let's see. All right, first things first, a little legal housekeeping. I am a CFP, not a CPA. This presentation is for educational purposes only. Anything we discuss today should be reviewed with your CPA or tax professional, especially if we're talking about Roth conversions, distributions, or taxes. They're the real MVPs when it comes to keeping Uncle Sam at bay. We're also happy to work directly with them for any planning purposes. Now that that is out of the way, let me start by saying this. You are not alone if Social Security has you scratching your head. The rules are layered, the language is outdated, and the website, let's just say it's not winning any awards. When I first started studying Social Security, I felt like I needed a decoder ring. But today I'll break it down using plain language, a little storytelling, and some relatable examples. By the end of this, I promise you'll understand more than most financial professionals do. Let's tackle one of the most common fears. How many of your friends and family are telling you, take it early, it's going bankrupt? Well, I hear this all the time, especially from people in their early 60s who want to get their hands on those checks ASAP. But here's the deal. Social Security is not going bankrupt. The trust fund may be projected to run low by 2035, but that doesn't mean benefits stop. It just means current revenue wouldn't be enough to pay 100% of scheduled benefits. That's a very different story. Think of the trust fund like a bathtub. Water, or revenue from payroll taxes, is flowing in. At the same time, water is draining out as we pay benefits to retirees. The challenge is we now have more people draining the tub than filling it, thanks to longer life expectancies and the big wave of baby boomer retirements. And let's be real, that probably includes a good number of you tuning in today. I see you. But even if the bathtub runs low, you're still getting a good portion of your benefits. It's currently projected at 83%. And historically, when Social Security faced financial issues like in 83, Congress stepped in with a bipartisan reform package. We do expect they'll patch the leak again. The question is how. There are many thoughts out there. We think there are three main proposals being tossed out around DC. It's good to be aware of them. One is they could raise or eliminate the earnings cap. Right now, you only pay Social Security taxes on the first $176,000 you earn. That means someone making $1 million pays the same Social Security tax as someone making $176,000. Some proposals would create a second tier of tax on earnings above $400,000, but not giving those earners additional benefits. That would bring in more money without increasing future payouts. The second option is to raise the full retirement age. In 1983, Congress raised the full retirement age from 65 to 67. They might do it again, say to 68 or 69. That reduces long-term payouts. It's controversial, though. It can hurt people in physically demanding jobs or with shorter life expectancies. And then lastly, they're talking about changing how benefits might be taxed. Right now, if you make over $34,000 as a single filer or $44,000 joint, up to 85% of your benefit is taxable. Those income thresholds haven't been changed since the 80s. And just like shoulder pads and mullets, they're overdue for a refresh. So rather than waiting for politicians to act, let's focus on what you can control. When you claim benefits, how long you work, your income strategy, tax planning opportunities. These are the levers we can actually pull and the ones that make the biggest impact on your financial future. When should I claim? This is the most common question I get. I wish I could give you a simple answer. Like most things in personal finance, well, it depends. It depends on your health, life expectancy, income needs, spousal benefits, and your tax situation. So we're going to walk through all of those today so you can make a confident decision. Your primary insurance amount, or your PIA, is the monthly benefit you get at your full retirement age, or FRA. Your full retirement age depends on your birth year. If you were born in 1960 or later, it's 67. Everything revolves around this number. Claim before full retirement age, you get less. Delay past full retirement age, you get more. Think of full retirement age as your benefits starting point. Now, to qualify for Social Security, you need at least 40 quarters or 10 years of work history. And no, they don't have to be consecutive. You could work 5 years, take a 10-year break, say to raise a family, then work 5 more, and you still qualify. Also worth noting, even if you don't qualify, you may still be eligible for spousal or survivor benefits. So don't assume you're out just because you don't have a long work history. Your benefit is based on your 35 highest earning years. If you don't have 35 years, the missing years are counted as 0. So each additional year of work, especially if you're earning more now, can replace a lower or 0 year, increasing your average and your benefit. This is why some people choose to work a few extra years even if they don't have to. It can pay off in monthly benefits and future survivor benefits. So let me tell you about my Uncle Larry. Larry hit 62, bought a Hawaiian shirt, and said, "I'm retired, baby." He signed up for Social Security faster than you can say early bird buffet. But what Larry didn't realize was by starting early, he locked in a permanent reduction on his benefit. Forever. And it wasn't just his check that took a hit. Spousal and survivor benefits got trimmed too. Aunt Marge was not thrilled. She gave him the look. You know the one. The moral of the story, just because you can start at 62 doesn't mean you should, unless you like smaller checks and sleeping on the couch. Now, here's the kicker. If Larry had waited until age 70, his benefit could have been up to 76% higher. That is a serious raise just for being patient. And get this, COLA increases, that's cost of living adjustments, they start when you turn 62, even if you don't turn on Social Security yet. So you're not missing out on those sweet inflation boosts by waiting. Instead of locking in a lower check, he could have let it marinate, grow with COLA, and enjoyed a fat monthly benefit at 70. But hey, now he's camping in Flagstaff instead of cruising the Bahamas. We still love you, Larry. Now, Uncle Larry's cousin, let's call him Spreadsheet Steve. He did things a little differently. Steve pulled out a calculator, a whiteboard, maybe a spreadsheet or two. He ran the numbers and realized claiming early means more checks, but smaller ones. Waiting means fewer checks, but they're beefier. The break-even age, well, that's usually around 82 to 85. If you live past that, delaying benefits pays off big time. Steve said, if I live a long life, I want those big checks rolling in. And sure enough, by age 90, his total benefit could be $570,000 or more compared to Larry's $470,000. That's a $100,000 difference just for waiting a few extra years. But here's the thing. No one has a crystal ball. So it's not just about math. It's about values, health, risk tolerance, and your overall plan. If you're in poor health or need the income now, starting early might be the right move. If you're still working or want to boost your survivor benefits, delaying might make more sense. In short, there's no one-size-fits-all answer. Just make sure you're not making a life decision based on short-term feelings or Uncle Larry's impulse to buy that shirt. So does other income affect benefits? Well, you betcha. So Larry being Larry thought he could double dip, take his Social Security and pick up some part-time work to keep the cruise fund alive. But once those checks started getting smaller, he called in a panic. They're docking my benefits. I thought this was America. Well, we had to break it to him gently. If you work before your full retirement age and make over certain limits, Social Security can withhold part of your benefit. The good news, the money isn't lost forever. Once you hit full retirement age, your benefit gets recalculated and bumped up. It just takes time. And since Larry's new gig paid better than some of his earlier career jobs, it might even raise his primary insurance amount. Yes, even after benefits have started. So here's how it works. If you are under full retirement age, for every $2 you earn over the annual limit, Social Security will withhold $1. In the year you reach full retirement age, it's $1 for every $3 over the higher threshold. That's only up until your birthday month, though. And then after full retirement age, no limits, no penalties. Larry can make $1 million and still collect 100% of his benefits. If that's your plan, let's talk. I'd love to help you with that. All right, so is there a benefit for delaying? Well, at this point, Aunt Marge decided it was time to get involved. She found out she could get a benefit based on Larry's primary insurance amount. And here's how here's how it works. Spouses are entitled to the higher of their own retirement benefit or 50% of their spouse's benefit. You do have to be at least 62 to qualify, and starting before full retirement age does still reduce your benefit. Both spouses must have turned on their benefits for spousal benefits to kick in, so Larry had to activate his first. And just like a good relationship, the marriage needs a little time. You have to be married for at least 1 year, unless your parents are the same child. And in case things go sideways, divorced spouses may also qualify if the marriage lasted at least 10 years and they're currently unmarried. So one evening after dinner, Aunt Marge got serious. She asked Uncle Larry what happens if he dies before her. Well, Uncle Larry choked on his iced tea as he moved the steak knife away from Aunt Marge. Well, let's walk through what happens if Larry passes away before Aunt Marge. A surviving spouse is eligible to receive the higher of their own benefit or their deceased spouse's benefit. Survivor benefits can begin as early as age 60 or age 50 if disabled, but they will be reduced if they start before full retirement age. There's also a $255 lump sum death benefit. Definitely not a game changer. Right. Now, remarrying before age 60 disqualifies you from receiving survivor benefits, but if you remarry at 60 or later, you can still collect them. The surviving spouse may also start with survivor benefits and switch to their own benefit later, or vice versa, depending on which is higher. Lastly, divorced spouses may be eligible as well if the marriage lasted at least 10 years and they're currently unmarried, or if they remarried after age 60. In actuality, survivor benefits can play a key role in retirement income planning, especially for couples with age differences or significant income gaps. Aunt Marge is starting to realize keeping Larry around is a good investment for her. Now, Larry's buddy Mel is a numbers guy. Spreadsheets, color-coded tabs, all of it. I know some of you clients here can relate to that. You know who you are. Mel and his wife Mari had a solid plan. Mel's Social Security, $3,000 a month. Mari's, $1,500 a month. They had an IRA worth over $1.4 million. They were spending about $120,000 a year and expected that to go down to about $90,000 after Mel passes. Mari's expected to live until 90 and Mel to 80. We assumed investments had a 5% return and a 2.5% inflation rate. So Mel modeled 3 Social Security filing strategies for their retirement. Well, scenario 1, Mel and Mari file as early as possible. 2 is them filing as late as possible. And 3 is a bit of a hybrid approach. Mel delays until 70, Mari files at 62. Now, what we're looking for in this comparison is the impact on income early versus later in retirement, how this impacts IRA withdrawal rates, survivor income, and lifetime benefit totals. In scenario 1, they filed as early as possible. Felt great at first. More immediate income and a smaller IRA withdrawals. But by year 26, the IRA was nearly depleted. Why? Smaller Social Security checks created a bigger income gap. Mari lived another decade after Mel passed. Inflation chipped away at the purchasing power, and her survivor benefit was based on Mel's reduced amount. Now let's look at scenario 2. Both Mel and Mari delay until age 70. This meant no checks for several years, but when they started, they were big. Higher benefits reduced their reliance on the IRA in later years. Mari's survivor benefit was also based on Mel's age 70 amount, a big win. It's a big win for her long-term financial security. The IRA dipped steeply in the early years, as you can see, but then it stabilized. By year 26, their portfolio was still going strong. Now we have scenario 3, the hybrid strategy. Mel files at 70, Mari files at 62. This gave them some early income while still building up Mel's benefit and ultimately Mari's survivor benefit. IRA withdrawals were moderate in early years, not too aggressive, not too light. Survivor income was still strong because of Mel's delay. This approach helped stretch the IRA the longest. This is the scenario I often recommend for couples with age differences, health differences, or if one partner has a significantly higher benefit. Here's the takeaway. Scenario one gives them the highest IRA balance at 70, but their Social Security income is permanently lower. Scenario two gives them the best long-term Social Security income, but shrinks their IRA earlier. And scenario three offers strong survivor protection, smoother income, and a more balanced approach. This case shows that timing really does matter, not just for income. These decisions affect taxes, longevity risk, portfolio health, and your legacy. So if you're married or planning with a partner, it's essential to run the numbers together, not in isolation. At this point, Larry's starting to feel like he may have made a mistake. Can he change his mind? Well, Mel reminded him there are a few limited options to consider. There's the start, stop, start, which is basically a withdrawal of the application. It has to be done within 12 months of claiming, and you have to repay all the benefits that have already been received. And then you can reapply later for a higher benefit. There is a voluntary suspension. After full retirement age, you can do this. Benefit stops, and then you earn an 8% annual growth until 70. And then, as I mentioned earlier, you can always switch benefits. So if you're eligible for two different, so retirement and survivor benefits, you can start one and switch to the other one later. And see, we can go over that if you have any questions. All right, just when Larry thought he'd heard it all, Mel hit him with one more bombshell. Social Security can be taxable. Larry's eyes went wide. They tax the money they already took from me? Yep. Welcome to provisional income. So this is provisional income it includes wages, IRA withdrawals, interest income, and half of your Social Security benefit. They use this calculation to determine how much your Social Security is taxable. For single filers, if provisional income is over $34,000, then up to 85% of your Social Security income is taxed. For married filing jointly, if it's over 44,000, then up to 85% is taxed. Larry's thinking to himself, the more I save, the more they tax? Oh yeah, pretty much. Which is why smart tax planning is just as important as smart investing. Here's where things get a little nerdy, but also really important. If you retire before taking Social Security or hitting required minimum distribution age, you might have a few lower income years. That creates a great window to do Roth conversions, basically moving money from your IRA into a Roth while taxes are relatively low. Yes, you're paying taxes on that money now, but you're doing it on your terms at a lower rate and avoiding bigger tax surprises later. It's what we call the conversion window, and it can make a big difference down the road. Take Mel and Mari, for example. Mel knew that after he passed, Mari would be filing taxes as a single person. That's a lot different. It usually means higher taxes on the same amount of income. So while they were both alive and in a lower tax bracket, he started converting some of their IRA to Roth. That gave Mari more flexibility, reduced her required minimum distributions later, and helped keep her future tax bill in check. Now, Roth conversions aren't for everyone. With a little planning, they can be a really smart move, especially if you're thinking ahead for your spouse or looking to keep more of your retirement income. All right, let's switch gears and talk about something exciting, especially for public employees. The Social Security Fairness Act came out recently. This eliminated two provisions that reduce benefits for people with pensions from non-covered jobs. That's huge. This new law is a game changer for some retirees, especially for those with non-covered pensions. Social Security Fairness Act eliminates reductions from the WEP and GPO for retirees with pensions from jobs that didn't pay into Social Security. It applies retroactively to January 1st, 2024. Lump sum payments may be issued, but calculation methods aren't finalized. The Social Security Administration is still evaluating how to implement it, just like anything else in government. We come out with a law and then we're not sure how it's going to work yet. The one thing to keep in mind, just like we talked about that bathtub draining, this may speed up the depletion of the Social Security Trust Fund. So we'll have to figure out how that's going to work out. All right, here's what we've learned today from Larry, Marge, Mel, and Mari. Timing matters. Don't rush to claim without knowing the trade-offs. Survivor and spousal benefits need to be part of the plan. Your strategy should reflect your life, income, and longevity. If you've already claimed, you might still have options. And we talked about the taxability of Social Security. Plan accordingly. And then lastly, Roth conversions. It can protect survivors and improve after-tax income. So whether you're a few years from retirement or already collecting benefits, now is the perfect time to revisit your strategy. Schedule a call with me, send us your questions, or let us run the numbers like we did for Mel and Mari. Learn from my Uncle Larry. Better to ask now than run out of money when it's time to book the cruise. So we're about to open this up to questions, but before I do, I want you to mark your calendars for the next webinar focused on college savings plans, scheduled for May 27th, and it's hosted by Larry Van Quatham. Before you ask, no, this isn't my Uncle Larry. So, thank you very much, and we're now going to open this up for any questions you have.
So Matt, excellent job. That was a wonderful presentation and a lot of great information. And if any of the attendees have questions, please use the chat feature that is associated with this Teams software, and we will address those questions. So please use the chat feature if you have questions. And naturally, determining when and how to take your Social Security benefits is a very individualized process. There's not a cookie cutter, one size fits all approach. Hopefully, if you learn nothing else out of today's presentation, it's that Matt knows his stuff when it comes to the ins and outs, and our team is here and ready to assist you and those that you care about. So we'll look to collect any questions if they are, if you have them, and I'll stop talking and wait for those to compile, and we'll go from there. While those may be using the chat feature to type in their questions, Matt, I'll ask you a question around, maybe it's a little bit of a philosophical one, but do you think that delaying Social Security to obtain the higher benefit is a way to almost approach investment allocation as a way to gradually get more conservative as people get older? In other words, using more variable sources of income earlier. Would you talk to that a little bit?
Yeah, I think that goes back to the bathtub draining. I know that there is fear of that being less, but having more of the confident income in the future, or the guaranteed, the more that we can get of the pieces for for your expenses down the road, the better that we're going to be. And even if we have to use some of your savings from retirement and taxable accounts up until then, um, I still think that it's worthwhile to hold out. Obviously, to your point, the everyone is a little bit different. I love our planning software. I always lean on that because some clients don't have the ability to hold off until that kicks in. But with our planning software, eMoney, selfless plug, we are able to run any of these scenarios to show you with actual numbers whether it makes sense to take it now or delay. I used to have a strong bias on delay, 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 and I still probably lean more on that way. But I've run into quite a few scenarios where actually taking it earlier for one, especially with married couples, makes sense. So,
Um, so thank you for that. So um, there haven't been any questions that have been posted to the chat. However, if you have questions post webinar, you can email Matt or any member. I'm Adam Brooks, co-founder of Able Financial Group. We have a wonderful presentation for